Question 25 is on the topic of construction contracts and how we account for these both in the statement of profit or loss and in the statement of financial position. So in this case we're looking at a 2-year contract to construct an office building for a fixed price of $26 million. During the first year of the contract, $17 million of costs have been incurred, and we're forecasting that a further $11 million will need to be incurred in order to complete. As at 31st of March 20X5, $14 million of work has been certified, and to date progress billings of $12 million have been made. In this case, the company uses work certified as a percentage of contract price to calculate the state of completion. So first thing we need to do with a construction contract is actually forecast what our profit or loss is. So in this case there is a fixed fee of $26 million against which costs have been incurred to date of $17 million, with a forecast of further costs of another $11 million, so that by the time we get to March 20X5 our forecast is that a loss will arise on this contract of $2 million. Because this is a loss, in accordance with our prudence concept, we need to recognise that in full now. So in terms of the statement of profit or loss entry, the revenue line for this contract will reflect the $14 million certified value of the work. We need to record the full loss of $2 million, and therefore the cost of sales entry, the purchases line, would be a balancing figure in this case of $16 million. So this actually gives us the first of our two correct answers that we need to go and identify. Cost of sales of $16 million and revenue of $14 million should be recognised in the statement of profit or loss. The third of the statements we need to identify relates to the statement of financial position and what would be reflected there. So the SFP entry would be calculated by taking the costs that have been incurred to date of $17 million, the loss that we've said we need to recognise of $2 million, but then showing that actually the customer has already paid in part for this contract $12 million. The net effect of these is to leave us with a $3 million balance, which is an amount due from the customer and therefore should be reflected as an asset. So that this option here is the third of the correct statements that we needed to identify.